Hello and welcome to this session in which we will discuss auditing notes payable. Specifically, we would look at the internal control that deals with this cycle. In the prior session, we looked at the overall introduction of the capital acquisition and the repayment cycle. What does that mean? It means we looked at how companies raise money, capital acquisition, and how do they repay this money through principal, interest, and dividend. Notes payable is a form of capital acquisition. This is how you raise money. But notes is a debt. It's a legal obligation. It's a signed promise that you will repay the borrowed money to the creditor plus interest. Now, when you borrow money, sometimes these notes are as simple as short term. For example, for 6 months, 9 months, less than a year. Sometimes they could be long term. Now, for companies, they could be complex agreements, they could be long term, they could involve collateral. So when we talk about notes payable is a form of borrowing, but sometimes we can borrow money through other methods. The process could be complex. For example, we could borrow money through bonds payable. Well, is notes payable and bonds payable the same? No. Bonds payable is when you can borrow money from anyone, from the public. Anyone can buy your bonds, versus notes you are borrowing from a single lender. Nevertheless, they are both a form of a legal obligation and borrowing money. Same thing with a mortgage. What's the difference between notes payable and a mortgage loan or a mortgage payable? In a mortgage payable, the mortgage is securing, it's a secured borrowing. Secured means the lender is having an asset as a security. So if you don't pay back the loan, they will take this asset. Versus a notes payable, it could be unsecured. Simply put, you trust the borrower, the lender trusts the borrower, and they don't need any collateral. So auditing notes payable is a sample for auditing other similar liabilities. So everything that we discuss in this session will apply to other long-term debt, to other liabilities, because they all work the same way. Now, obviously, notes payable is different than bonds. Bonds is different than mortgage. Mortgage is different than notes. But when you audit them, the objective, what you should be looking for, is the same, and that's why I will focus on notes payable as a sample. So the first thing I do, I'm going to go over the process, the accounting process, then we'll dive into the internal control for notes payable. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here.
This is a basic overview of how we put a notes payable on the books and how do we remove it. Remove it. The first thing we do is we borrow money. When we borrow money, we start a notes. We debit cash, credit notes payable. In this situation, we borrowed $1 million. We debited cash, credited a payable. This loan might require us to make a payment of $100,000, so we credit cash, we debit the notes payable, and we debit interest expense. Therefore, when we make the note payment will be some of the payment will go toward the principal, $20,000, some of it goes toward the interest. Now, if you are dealing with a bonds, the payment usually would go against the interest expense 100%. Then you buy the bond, you pay the bonds later in one lump sum payment. But the process is the same. You credit cash and you either increase expense or reduce your notes payable when you make the payment. Simply put, you are satisfying your interest expense and you are satisfying the note, reducing the note. And sometimes what could happen is at the end of the period, you might have to debit interest expense and credit notes interest payable to accrue some interest that occurred during this period that you have not recorded it yet. So for example, here you will have the cash balance, you will have the notes payable balance, which is 980,000. So the beginning balance is 1,000,000, the ending balance is 980. You will have the interest expense for the period is 95, and you have 15,000 of interest payable. Usually these are the accounts that are involved when you are accounting for notes payable. Why do I always go over the accounts? Because if you know the process, you need to know the gap before you know the audit, and that's why I do that. Now I'm going to focus more on the objective of auditing notes payable. Go over them briefly. We're going to discuss them a little bit more in details in other chapters, but I will focus today on internal control. Internal control shape the audit. First thing we need to know is, do we have proper internal control in place to prevent mistakes or fraud when we are managing the company's debt? That's important. Internal control. What else is important is authorizing and recording. So when we borrow money, we want to make sure that all new loans are authorized. Why? Because we should not let anyone borrow money on behalf of the company. They are properly authorized, and we'll talk about that. The interest charged properly approved. We agreed to the interest. Everything is documented and everything is recorded. So that's important. We want to make sure that the numbers are accurate. Does the amount owed and any associated interests are match what's really due? And we have to make sure if there's any disclosure or classification, are the terms, type, and collateral clearly spelled out. So is it short-term, long-term? Usually long-term loans are both. Long-term loans are part of it is short-term, part of it is long-term. If there's any collateral, did we disclose the collateral in the notes of the financial statements? So those are the things that we are concerned with. In short, we would look for evidence that nothing slipped through. And remember, we talked about completeness is very important in the cycle. In the prior session, we talked about this. Authorization is important. We did not borrow money when someone is not authorized to do so. We did not miss any repayment. We don't have any hidden collateral arrangement or anything like that. So those are the main objectives. Now we're going to look specifically at internal control pillars, and there are 4 pillars of internal control over notes payable. Now again, I said over notes payable, they could apply to mortgage, they could apply to bonds, they could apply to any type of liability. The first one is we kind of touched upon proper authorization, adequate control over repayment, proper documentation and record keeping, periodic independent verification. Now since I have a list, what do I do every time I have a list? Is I go over each item on this list separately, starting with proper authorization for issuing notes. Now, you have to understand, when you want to borrow money from a bank or from a financial institution, and I was in the process recently of buying a home for myself. So they ask for a lot of documentation. So the lenders usually work as a proper internal control. So the lenders expect companies to limit who can take out loans. So they are not going to give you a loan if you work for that company on behalf of that company. They need proper approval. And that proper approval usually comes from the board of directors or the top executives. And usually the lender would ask you for your bylaws. They'll ask you, I want to know who could make a decision at your company. And they'll have a copy of them. Why? Because if you don't pay back the loan, they have some legal recourse against you that you showed me that the people signed this request are authorized. Otherwise, you cannot hold the company responsible. So you need a written approval from a designated people. Usually the board of directors or designated officers. They must document their okay before the bank gives you the loan. You might have multiple signature. At least 2 authorized individuals should sign the loan agreement, making it harder for one person to hide questionable borrowing or take the money for themselves. Also, you need details on the document. The loan amount, the interest rate, the repayment terms, and the collateral must be spelled out in writing. So this is all part of the proper authorization. Also, you need renewal clauses. Now, here's what you need to know about loans in the real world. When a company apply for a loan, they may get a loan, a 5-year loan or a 7-year loan. But what happened oftentimes, if it's a business loan, the bank would ask you, it's a 5-year loan, but every year you are subject to renewal. So before we say, technically it's a 5-year loan, but year 2 we have to go through the same approval again. Now the approval in year 2 could be very minor, but you will have to show them some financial statements. You have to show them that the company still want the loan. So renewal loans must get full authorization treatment again. So having every loan properly authorized help prevent hidden debt and fraud, because you don't want somebody also from the company borrowing money and pocketing this money. Because if you have the authorization to take the money out and no one is aware of it, then you can pocket this money and the company will be paying for it. So first you need proper authorization. Now this proper authorization could take different forms in different companies. Usually the board of directors, top management, or designated officers can approve loans. Approves means they approve that you request the loan from a lender. Let's take a look at this multiple choice question from farhatlectures.com. All the following are objectives of the audit of notes payable. They are objective, except 3 is yes, 1 is no. Okay, let's start with A. Transaction for principal and interest involving notes are properly authorized. Of course, you want to have that. That's one of the objectives. When you make the payment, you want proper authorization. That's out. The liability for notes payable and the related interest expense and accrued liabilities are properly stated. Yes, as part of the disclosure, you should properly state the notes, the interest expense, and any accrued liabilities related to it. Yes, that's one of the objectives. C. Maintaining an acceptable debt to equity ratio. Is this an objective of the audit? No. You don't care whether the company maintain an acceptable debt to equity ratio. That's their problem. You want to make sure the debt is correct and the equity is correct. As an auditor, it's not your concern if they are keeping an acceptable debt to equity ratio. An acceptable debt to equity ratio, that's their issue, that's their problem, that's their concern with the lender. The lender might have a concern if the debt to equity ratio is not acceptable, not the auditor. The auditor gives the audit the numbers, the debt, the equity, and whether they like the numbers or not, whether they are confirming with debt to equity ratio or the current ratio or the working capital, that's not your concern as an auditor. And the reason I am talking about this a little bit more, because when I was in practice, we had one issue with again, it was a funeral home business where they had many loans and they had issues with keeping their current ratio proper in terms of loan covenant. And they always came back and they disagreed with how we separated long-term and short-term debt. So, but that's not our problem. We report the numbers as is, whether they confirm with your ratios or not, that becomes an issue you have to deal with the lenders. So C is not. All the following are objective, except we don't maintain an acceptable debt to equity ratio. That's not our concern. D, internal control over notes payable are adequate. Of course, we have to have internal control over notes payable. What should you do now? You want to go to Farhat Lectures, look at additional resources, whether you are a CPA exam candidate, an accounting student, studying for a professional certification. The best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.